Welcome back to Talk Tickers. This is The Signal. We strip out the noise. It is early February 2026. And if you're watching the tape right now, you are seeing a market that is, well, it's taking no prisoners.
It is absolutely ruthless out there.
It's volatile, it's aggressive, and frankly, it is confusing a lot of retail money.
For sure. The VIX is waking up, and the algorithms are punishing anything that looks even remotely complex.
And that brings us to Lumen Technologies, ticker LUMN. They just dropped their Q4 and full year 2025 results. And this is, I think, the most confusing setup I've seen in the telecom sector in maybe a decade.
It's a mess. A fascinating mess, but a mess.
I mean, on paper, you have a beat. Adjusted EPS earnings per share came in positive, 23 cents. The consensus expected a loss of 21 cents. That's a huge swing.
A massive swing.
But then you look at the price action the next morning. Stock took a 15% haircut. That is just absolute violence for a company this size.
And that's the paradox we need to solve today. Why does a company that just paid off billions in debt, claims it's the backbone of AI, and beats earnings? Why does it get taken out to the woodshed?
Exactly. Is the market missing the forest for the trees? Or are the algos correctly sniffing out a cash flow problem that the headlines are trying to bury? That's our mission. We're going to dissect this print.
Let's get into the numbers.
Okay, hit me with a snapshot. What did they actually print?
All right, so that headline number, the adjusted EPS, came in at positive 23 cents. Like you said, the street was looking for a loss. So bottom line, a massive beat.
Okay, so they squeezed out a profit. But we all know accounting profits can be, engineered. What about the top line? Is the business actually bringing money in the door?
And that is where the rot starts to show. Revenue came in at $3.041 billion.
A slight miss.
A slight miss, yeah, but the real story is the trend. It's an 8.7% decline year over year.
Oof, nearly 9% shrinkage. That is not a growth company. That's a melting ice cube.
No, it is not. And profitability is compressing too. Adjusted EBITDA was $487 million. That's a 16% margin. A year ago, that margin was almost 28%.
Wow.
That is a massive deterioration. You just don't see margins collapse by 1,100 basis points in 1 year unless something is fundamentally broken.
But the number that really spooked the desk, the number that I think really caused the sell-off, was the cash flow.
The elephant in the room. Free cash flow for the fourth quarter was negative $1.082 billion.
Okay, pause on that. They burned over $1 billion in 90 days.
In a single quarter. Correct. Now, management has a defense for this, and it's a valid one. We'll get to it. But optically, seeing a $1 billion burn on a turnaround story, that is terrifying.
It just screams liquidity crisis to anyone just glancing at the headlines. But before we rip that apart, we have to talk about the balance sheet. Because literally hours before this call, on February 2nd, the company changed. Fundamentally.
The AT&T transaction, this is the pivot point.
Yeah.
They sold their consumer fiber business.
So your internet service at home.
Exactly. Gone. CEO Kate Johnson called this a new day for Lumen. But the market, selling it off 15%, suggests investors aren't buying it.
They're looking at that cash burn and running for the hill.
Right. Skepticism is at an all-time high. But, and this is a big but, the balance sheet argument is actually stronger than it has ever been.
Let's play devil's advocate then. Let's look at theme one, the bull case. You're long this stock. You're betting on the balance sheet miracle. Walk me through it.
It is a legitimate feat of financial engineering. The AT&T deal brought in $5.75 billion in cash.
A massive liquidity injection. Where did it go?
Straight to survival. It went to the debt. They paid off all their super priority bonds. Total debt is now sitting under $13 billion. Net leverage dropped a full turn to below 4x.
And for listeners who aren't deep in credit markets, why is 4x the magic number?
Because 4x is manageable. At 5x or 6x, you are in distressed territory where bankruptcy is a real conversation. Under 4x, you're just a standard leveraged telecom. The immediate bankruptcy risk is effectively zero.
And it's not just the principal, right? It's the cost to service it.
This is the insight most people miss. By paying off that high-interest debt, their annual interest expense is down nearly 45%. They are saving roughly $500 million a year just in interest.
$500 million. That's real money that can go to R&D or just, keeping the lights on.
Exactly. Plus, by dumping the consumer business, they cut annual capex by over $1 billion. They don't have to dig up front yards anymore.
So does this fix the company?
It fixes the survival risk. That's the key distinction. The conversation has moved from will they go to zero to can they actually grow? You can't cost cut your way to prosperity forever.
Right. Which leads us to theme two, the growth story. or as they're calling it, the AI backbone.
This is the narrative Kate Johnson is selling. She's positioning Lumen not as a telecom, but as the physical infrastructure for Cloud 2.0.
We hear a lot of buzzwords, AI economy, every company mentions AI, but there is a specific product here we need to define. PCF. What is it?
PCF is the acronym you need to know. Private Connectivity Fabric. Think of the public internet like a congested highway. PCF is like building a private underground tunnel directly from one data center to another.
So it's just dark fiber.
It's more than that. It's high-count custom conduit systems built specifically for hyperscalers, Amazon, Google, Microsoft. When they're training these massive AI models, the GPUs need to talk to each other instantly.
And this is the key insight, right? Speed matters. Because if you have $1 billion of H100s and they're waiting 5 milliseconds for data, that is GPU idle time.
Exactly. GPU idle time is the enemy. It is literally burning cash. Lumen's pitch is that their network reduces that idle time. It makes AI training cheaper and faster.
And the sales numbers seem to back that up.
They do. They signed about $2.5 billion in new PCF deals just in Q4. The total signed backlog is nearly $13 billion.
$13 billion. That sounds incredible. That sounds like a company that should be exploding higher. But, and here's the friction, if they signed $13 billion in deals, why is revenue down almost 9%?
Because of the lag. And this is what the market hates. These aren't software deals. These are construction contracts. Lumen has to physically put fiber in the ground.
How much revenue do they actually recognize from that $13 billion backlog in 2025?
116 million.
Wait, 116 million out of 13 billion?
Yeah.
That's a rounding error.
That is the disconnect. The market is impatient. The algos see revenue down today. They don't care about revenue up in 2029.
Okay, so a huge promise, but the current reality is ugly. Which brings us to theme 3, the ugly quarter. We have to go back to that negative $1 billion free cash flow.
It was a shocker. Now, to be fair to management, they had an excuse. There was a $400 million tax refund that was supposed to hit in Q4, and it got pushed.
Okay, fine. The IRS moves slow. That explains $400 million. That still leaves a $600 million burn.
It's still a severe burn. It shows the operational business is still very heavy on costs. They're spending money to build this network before they get paid for it. It's a working capital drain.
And then they did something that I know drives you crazy. They changed the reporting segments.
I despise this. And most professional investors do too. When a company's in a turnaround, the last thing you want is for them to change the labels on the buckets.
They used to have grow, nurture, harvest. At least we knew harvest meant dying.
Right. It was clear. Now it's strategic and legacy.
Why does that annoy the street so much?
Because it resets the baseline. It makes it harder to track performance year over year. It just looks like you're trying to hide the decline. And the reality is the legacy bucket is eroding faster than the strategic bucket is growing.
It feels like they're trying to hide the body.
Or at least smooth the edges. But the math is the math. And they actually put a date on when the growth really crosses over.
2028.
2028, that is 2 full years away.
So you have to sit here and watch shrinkage for 2 more years.
That's the guidance. In this market, 2 years is an eternity. That explains the sell-off. The algos are not programmed for eventually.
So let's look forward. The 2026 outlook, what did they guide for?
Revenue, 11 to 11.2 billion. EBITDA, 3.2 to 3.4 billion. And they claim EBITDA will inflect to growth in 2026.
Meaning it will finally stop going down.
Theoretically. But the number that really stood out was free cash flow. They're guiding for positive $1.2 to $1.4 billion for the full year.
Stop right there. They just burned $1 billion in 1 quarter. And now they're saying they'll generate over $1 billion next year. That sounds like math magic.
It's the multi-billion-dollar question. The bridge relies on 3 things. 1, the interest savings, that's the $500 million we talked about.
Found money.
Right. 2, the tax refund arriving, that's another $400 million. And 3, the lower capex from not building consumer fiber.
So it's mathematically possible.
Possible, yes. But it requires perfect execution. There is no room for error. If they miss that cash flow target, their credibility is shot.
There is an upcoming catalyst, though. We don't have to wait long.
Investor Day, February 25th, just 3 weeks after the earnings call.
Which is strange timing, isn't it? Why not do them together?
It suggests they have a story to tell that didn't fit in the script. The stock is going to be extremely volatile until then. The market is demanding proof. They want to see the J-curve.
The dip before the rep. They want proof that digital products like network as a service are actually being adopted.
Exactly. They mentioned NOS. Active customers grew 29% quarter over quarter. But is it enough to offset people canceling landlines? Not yet.
Okay, so we have a binary event, a battered stock, a confusing financial picture, but a clean balance sheet.
It's a fascinating setup for a trader. High risk, high reward.
Which brings us to the segment everyone waits for.
This is not financial advice segment.
Disclaimer time.
Yeah.
We are not financial advisors. We're just brainstorming wild ideas here. Do your own diligence.
Hypothetically speaking.
Hypothetically, look at the setup. Implied volatility is through the roof. The stock just got crushed. Everyone's bearish. But you have this investor day coming up.
And a management team that just cleared the debt deck. They aren't acting scared.
So here's the outrageous trade pitch. The dead cat bounce spread. Or technically, a leveraged risk reversal.
Walk me through it.
The thesis is the market overreacted. They ignored the balance sheet fix. The AI narrative is too strong for this to stay down forever.
Okay.
So the play, you sell out of the money puts, you collect that fat premium from the bears.
Because the fear is high.
Exactly. You use that cash you just collected to buy at the money calls. You're financing a bullish bet with the bears' money.
That is aggressive. You're betting the stock won't drop further, and you're betting on a pop.
Precisely. If Kate Johnson comes out on the 25th and shows a slide that proves the J-curve is real, this stock gaps up to fill that post-earnings drop.
And if she doesn't?
Then you own a lot of Lumen stock at an even lower price, which, given the debt profile, might not be the worst thing in the world.
It's a high conviction play. I have a slightly more structural idea.
Let's hear it.
Capital structure arbitrage.
Classy. Explain it.
Look, the equity is the volatile piece. That's where the AI premium lives. But the debt is now money good. It's much safer than it was a month ago.
But the equity is where all the action is.
So you go long the equity to catch that AI wave, but you hedge it by shorting the general telecom sector ETF. You're isolating the specific Lumen upside.
You want the alpha without the beta.
Precisely. With bankruptcy risk gone, the equity is basically a long-dated call option on the success of their AI strategy. If it plays out, the equity is a multi-bagger. If not, the floor is much higher than it used to be.
That's a great way to frame it. Lumen is no longer a distressed debt story. It is a venture capital bet on AI infrastructure, wrapped inside a legacy telecom shell.
That is the perfect summary.
So what does this all mean for you listening right now? Lumen is the tale of two companies. You have a dying legacy telecom, and you have a booming AI infrastructure builder.
The balance sheet is fixed. The P&L is messy.
And the question is time.
It's patience arbitrage. That's the concept I want to leave you with. Can you afford to hold a stock for the 2028 growth promise when the algorithm traders are selling the 2026 revenue decline?
If you have a 2-year time horizon, this looks interesting. If you have a 2-week time horizon, it looks terrifying.
That is the signal. Ignore the noise.
Yeah.
And check the investor relations page. They're releasing an 8K with pro formas. If you want to see what the real Lumen looks like going forward, you have to read that document.
Absolutely. Do the homework. We'll be watching that investor day on the 25th like a hawk. Until then, keep your head on a swivel.
And watch the cash flow.
Always watch the cash flow. Thanks for listening to Talk Tickers. We'll catch you on the next print.